If you're proposing a 30% tax rate for personal income tax, as well as company tax being 30%, why do they actually need to be the same?
Well, my way of looking at it is that a company is comprised of members who are shareholders, and shareholders are people. And I can't see why the corporate rate should be any different from the top personal rate. There are people who are running around advocating a lower corporate rate. But I think the best aim is for us to all aim for a lower corporate and personal rate so that they go down in tandem.
The suggestion also being that the taxation rate on export income be 10%.
Yes, well, many multinational companies appropriate their profits into zones where their corporate rate is around that or less. They might only do 5% of their world trade in that particular country, but they might pay 50% of their world taxes in that particular within that particular entity. I'm convinced that Australia loses very, very greatly because of the high corporate rate compared with international competitors.
Wouldn't it be just easier to change the current laws allowing these companies to pay their taxes elsewhere?
It's not as easy as that. International law, particularly, it's a very difficult subject, and I don't think many legislators really want to come to grips with it. Plus, it's just a very, very wide field. If we here in Australia could control it, we really can't control what happens overseas. We could change behaviour so that the geese that lay the golden eggs will fly back into Australia.
And you think that 10% tax rate will do it?
Absolutely. There are many international companies who could do more in Australia as far as producing a greater quantity of their world produce.
You've mentioned the 15% tax that is imposed on superannuation going in, but what about the earnings of a superannuation fund? That too is taxed as well, isn't it?
Exactly. So there's a double dip there. So for every $1,000 that goes into a superannuation fund, it's reduced to $850, and for every $1,000 of interest that the superannuation fund earns, gets effectively reduced to $850.
That must mean a fairly large amount of money for somebody who's going to be retiring and using their superannuation pool.
When you compare the compound effect over a 30-year period, it could make a 30 to 40% difference in the amount of money received by the retiree.
And that has to be a lifestyle factor for that person, hasn't it?
It's got to be cancel the Winnebago and just go around Australia on a motorcycle, I think.
So with your proposals, isn't the government going to miss out on money?
Yes, they'll miss out on about $8.5 billion on the example that we've just discussed. However, they'll repatriate that if they start taxing at the ordinary top marginal rate when a fund gets to, say, 10 or 12 times average weekly earnings.
Is that going to compensate sufficiently?
I think so. Yeah, absolutely. The larger funds will compensate for that because they're only paying 15% now. They'll be paying twice that.
You're proposing not only a change to capital gains taxes, but also a change in name. In actual fact, you're suggesting a capital exit tax. What is that? How does it work?
Well, that would be just a tax on all transactions, on the value of each and every transaction, whether it be shares or real property.
How much would you be proposing?
I think that compensation would occur compared with the current rates of revenue gained at somewhere between 0.5 and 0.7% on all transactions.
You're suggesting that figure as against currently a tax on the capital gain from the sale?
That's
but on the entire
on the
sale.
entire value of the transaction of 0.5% to 0.7% instead of a tax of 15 to 30% on the profit.
What if my profit is only small?
You might even make a loss, but the simplicity of this system, it will raise current revenues quite simply. It won't distort your capacity to make decisions as to which way you invest, whereas the current capital gains tax is a nuisance to you. You mightn't participate in a lot of investment programs that you otherwise would because of this current capital gains tax.
So you're suggesting the simplicity of it is the thing that makes it that much more tasteful?
I think most investors would rather know where they stand and have no further relationship with the taxation authorities in regard to their private business transactions.
So the game of roulette of capital gains tax is then taken out of the equation?
That's right. It's not there. It's just virtually, for want of a better word, a type of stamp duty on the sale of all assets.